And if you don't understand what it means, your portfolio is already behind. There's a pattern buried inside Berkshire Hathaway's latest filings, a pattern that the smartest institutional money on the planet is already responding to. By the end of this video, you'll know exactly what that pattern is, what it signals for the next 12 to 18 months, and the specific moves retail investors should be thinking about right now. But first, let's talk about the number that should have every investor's full attention. That is the cash and short-term treasury holdings sitting inside Berkshire Hathaway right now. Not a rough estimate, not a rounded figure. $189 billion, a record high in the company's entire history. Let that sink in for a second. The greatest capital allocator of the modern era, a man who has compounded wealth at roughly 19.8% annually over 6 decades, is sitting on more cash than the GDP of most countries, and he's not spending it. Now here's where it gets interesting. While retail investors poured money into equities throughout 2024, chasing momentum, chasing AI plays, chasing the S&P's relentless climb, Buffett was quietly doing the opposite. Berkshire was a net seller of equities for 7 straight quarters. 7 quarters. That's not a portfolio trim. That's a deliberate, methodical repositioning. And the single biggest move, Buffett slashed Berkshire's Apple position by approximately 50%, cutting one of the most celebrated equity holds in modern financial history. Apple, the stock that turned Berkshire's $36 billion investment into a position worth over $170 billion at its peak. Gone. Half of it. Just like that. Here's the part most commentators get wrong. They call it profit-taking. They call it tax-driven. And sure, there's truth in both of those narratives. But zoom out. Look at the whole picture. It's not just Apple. Berkshire also significantly reduced its stake in Bank of America, offloading more than $9 billion worth of shares over a relatively short window. That's a meaningful reduction in financial sector exposure from a man who built much of his fortune on financial sector exposure. And here's where the macro picture becomes impossible to ignore. Buffett isn't just selling stocks. He's replacing them with short-duration U.S. Treasuries, instruments currently yielding north of 5% with essentially zero credit risk. Think about what that tells you. When the most patient long-term investor alive decides that a risk-free 5% return is more attractive than deploying capital into equities, that is a signal about valuations. Full stop. The S&P 500 cyclically adjusted price-to-earnings ratio, the Shiller CAPE, recently sat above 34x. Historically, readings above 30x have preceded periods of significantly below average 10-year forward returns. Buffett doesn't cite the CAPE publicly. He doesn't have to. His portfolio is the thesis. While retail investors are celebrating all-time highs, institutions are stress testing for the downside. But here's the part that changes the whole picture. Everyone's focused on what Buffett sold. Almost nobody's talking about what he kept, and what that tells us about where he sees durable value. Berkshire still holds approximately $84 billion in Apple after the reduction. It still holds Coca-Cola, a position it has held since 1988 without selling a single share. It still holds American Express, Chevron, and a cluster of insurance businesses generating billions in float. This is not a man running to the exits. This is a man making room at the table. Think of it like this. You don't clear your plate because you're done eating. You clear your plate because something better is coming out of the kitchen. Buffett has been explicit about this framework in past shareholder letters. He's waiting for what he calls the fat pitch. A moment when fear drives asset prices to levels where deploying capital offers extraordinary risk-adjusted returns. In 2008, that fat pitch arrived. Buffett deployed $5 billion into Goldman Sachs at distressed terms, preferred shares with a 10% dividend and warrants to buy common stock. He made a fortune. In 2020, when the market crashed 34% in 33 days, Berkshire sat on its hands because the Federal Reserve intervened so aggressively that the fat pitch never materialized. That at current valuations, with the S&P near all-time highs, credit spreads compressed, and geopolitical uncertainty running hot, the fat pitch hasn't arrived yet, and he's willing to earn 5% risk-free while he waits. So what does this mean for you, a retail investor trying to make sense of a market that feels simultaneously expensive and unstoppable? 3 takeaways. concrete, actionable, no fluff. Buffett's 28% cash allocation inside Berkshire isn't paralysis, it's discipline. Retail investors have been conditioned to believe that cash is trash. But at 5% yields on money markets and short-duration treasuries, holding dry powder isn't just defensible, it's strategic. You don't need to be fully invested to build wealth. You need to be intelligently positioned. If the Oracle of Omaha can reduce a position that generated hundreds of billions in unrealized gains because the risk-reward calculus shifted, so can you. Review your portfolio. If a single position represents more than 20 to 25% of your holdings, ask yourself, am I holding this because it's still the best use of this capital, or because I'm anchored to the entry price? Every quarter, Berkshire files a 14F with the SEC. That filing reveals every equity position over $100 million. It's public, it's free, and it is one of the most underutilized research tools available to retail investors. The next filing will tell you exactly what Buffett's team was buying or still selling through the most recent period. The data is sitting right there. Most people never look. Now here's the question I want you sitting with after this video ends. Drop your answer in the comments. I read every single one. The market rewards patience. It punishes impatience, disguised as conviction. Buffett's portfolio isn't just a collection of stocks, it's a real-time macro thesis, written in capital allocation, not words. And right now, that thesis is whispering something most retail investors aren't ready to hear.